Good afternoon, good morning, good evening, wherever you are around the world, and welcome to the next hour or so session on ethical standards and updating you on the recent changes introduced by the International Ethics Standards Board. My name is Alan Morgan. I'm an Executive Director of Kudos International Network, and I've spent the vast majority of my professional life talking to small and medium-sized firms of accountants, initially in the UK and Ireland, and now increasingly over the last 10 years or so on a global basis, talking to firms such as yourselves about implementing auditing standards, accounting standards, and indeed ethical standards in a cost-effective and practical fashion. And talking about discussing items in a practical fashion, you do have the facility today to ask me any questions as we are going along. I would be grateful if you could do so using the GoToWebinar software that you are watching the broadcast on today. What has changed in the area of ethics standards in the last 12 to 18 months or so? Well, actually, the answer is quite a lot, and there's quite a lot of changes that will be coming through on stream in the next 2 to 3 years, and potentially beyond that, as we will explore through the course of this particular session. Before we start, I'd also like to point out that I'll be concentrating today on the ethical standards issued by the International Ethics Standards Board. One of the problems with ethical standards that doesn't really apply so much with accounting standards and auditing standards is that different countries, different jurisdictions, and different accounting bodies, different professional organizations impose slight variations on the ethical standards on their membership. So some of what I'll be talking about today may not apply in your particular jurisdiction, and that can be for a whole plethora of reasons, such as in some countries, perhaps it takes a number of months or years indeed for some of the international changes to be brought into the professional organizations' ethics standards within a particular country. And also, particularly when it comes to the rotation of audit firms and audit partners, which is something that we will be talking about later on this hour, there are different rules in different countries. So the rules in certain South American countries will be different to the rules in the US, will be different to the rules within the European Union, which may again be different to the rules in Asia and Africa. And indeed, in some of those areas, there'll be differences in particular jurisdictions as well. Some of those differences I may well touch on when we talk about auditor independence later on. And we have an update session indeed on auditor rotation. Specifically in this session this morning, I will be discussing the new standard on non-compliance with laws and regulations. And indeed, as this is a relatively new standard, the bulk of the morning is likely, the bulk of this session is likely to be taken up with this particular standard. Just excuse me for one moment while I take my watch off, as then I will be able to tell what the particular time is. The non-compliance with laws and regulations standard was introduced by the International Ethics Standards Board in 2016. So it's been with us now for around about 18 months. But in many jurisdictions and many professional organizations are only now implementing the no-CLAR ethics standards. So we'll explore how that affects accountants in practice, comment upon the effect of accountants on accountants in business, and also work through a particular example as well. Be commenting on an update in terms of auditor rotation on public interest entities only, the rules on auditor rotation, particularly audit partner rotation on non-public interest entity audits have significant variations around the world. So that is not a subject I'm going to be covering during the course of this particular update. However, in this particular part, I will be talking about audit partner rotation on public interest entity audits under the IESBA Code of Ethics, and also briefly commenting on some of the changes in respect of auditor rotation being brought in within the European Union at the moment. And by that, I mean audit firm rotation. At the moment, the International Ethics Standards Board for Accountants is rewriting its code of ethics, which doesn't seem, which actually isn't as drastic as it may first seem, and the volume of practical changes as a result of the new code of ethics at the moment do not seem to be that extensive. They are being rewritten with the primary purpose of making them easier to understand and to present the code of ethics in a slightly more logical fashion. Finally, I will be touching upon a subject that some of you, particularly those of you working in international networks, may well be more familiar with, and that's the consultation being put together at the moment by the monitoring group for auditing standards worldwide. The monitoring group is the group which feeds ideas into the International Audit and Assurance Standards Board, and indeed the International Ethics Standards Board for Accountants. However, the monitoring group issued a consultation document in November 2017, which is likely to change substantially the standard setting process and may well, in fact, derail the new IESBA Code of Ethics potentially if some of the changes come through to the standard setting process much quicker than possibly initially anticipated. That will change the way in which standards are set globally for auditing standards and indeed for ethical standards. And many people within the profession have significant concerns about this particular consultation, and I'll talk more later on about what's involved in that. Without further ado, then, let's go on to talk about this new standard from the International Ethics Standards Board for Accountants called NOCLAR, or short for non-compliance with laws and regulations. This came into force in July 2017, having been published in 2016. And also, as I commented on earlier on, although we'll be talking about the effect of NOCLAR today on accountants in practice, it also affects accountants that are professionally qualified accountants that work in business. So, for example, one of the effects of the NOCLAR ethical standard now is that those members who work in industry, in business, who aren't in practice at all, will have to abide by this standard. And if they become aware that within the business that they're working in, there has been a breach of a serious law and regulation that the company has to abide by, that could result in a significant decrease in that business reputation, or could result in a material misstatement of the accounts, there are certain procedures that they need to abide by. Just in passing, at the end of this session, I will probably comment upon the effect of the NOCLAR standard on members in business as some closing remarks to this particular section. But as I said, we'll be concentrating very much on the implementation of non-compliance with laws and regulations as an ethical standard for those professional accountants working in practice, or actually being in practice as partners or directors in firms of auditors and accountants worldwide. And actually, before I move on, another further comment in terms of NOCLAR is that it's important to remember that this particular ethical standard, because it is an ethical standard, doesn't just apply to audit work. It applies to all work that a professional accountant may conduct when working in practice or actually being in practice. So it will include consultancy work, other assurance work, compilation work, such as preparing annual accounts or management accounts on behalf of clients, consultancy work. All this type of work is covered by the NOCLAR ethical standards. It doesn't just apply to audits. We may already think about the laws and regulations, auditing standard ISO 250 applying to audits, and that standard has been slightly changed as a result of NOCLAR, but it is not just audit clients that NOCLAR applies to. It applies to any work which the professional accountant actually performs in practice. Within the standard, NOCLAR is defined as any act of omission or commission, intentional or unintentional, committed by a client or employer, including by management or by others working for or under the direction of the client or employer, which is contrary to prevailing laws and regulations. And you notice there the language client or employer. In other words, this equally applies to members in practice and members in business. And of course, importantly perhaps, the word employer also covers non-compliance with laws and regulations that an accounting practice may commit. Individuals who work within that accounting practice also have a responsibility under NOCLAR to potentially make appropriate reports to a regulatory body. We'll talk later on about who that regulatory body might be, as in my experience on giving presentations on this particular standard, the identity of who the regulator actually is something which many firms do seem to struggle with, or many individuals rather do seem to struggle with. The one caveat to that particular definition is there is a subsequent paragraph within the NOCLAR standard, which says the following: the laws and regulations covered violations of which are acts of NOCLAR are those that directly affect the client's or the employing organization's financial statements or its business in a material or fundamental way, which is a formal definition, I suppose, of something which I said earlier on in this presentation, where I highlighted the fact that in order for a breach of a law and regulation to be an issue under NOCLAR, it has to be something which will significantly affect the organization's financial statements or its business in a material or fundamental way. In other words, it will significantly impact perhaps on that business's reputation. Laws and regulations which may well be covered under NOCLAR may include anti-money laundering. Probably best to use the phrase anti-money laundering as opposed to money laundering. Health and safety, fraud legislation, corruption legislation, bribery legislation, but in fact, any legislation which could affect a particular organization's financial statements or its business in a material or fundamental way may well become an issue under NOCLAR if you become aware that a client has breached that key law or regulation. This doesn't mean to say, it's important to note, that as part of your work when conducting consultancy work or conducting tax work, that you must look for breaches of laws and regulations. That's where NOCLAR differs from ISO 250. With an ISO 250 on an audit assignment, there is a certain amount of testing that you must do on the client's internal procedures, perhaps to go looking for breaches of laws and regulations that could materially affect the financial statements. In the case of NOCLAR, there is no obligation on the accountant in practice to actually go looking for breaches of laws and regulations. So if, for example, you are doing consultancy work for a chain of restaurants, there is no need for the reporting accountant, in that particular case, you as a consultant, to go looking for potential breaches of hygiene regulations or any other regulations that a chain of restaurants has to abide by in a particular country. So there's no obligation to look for breaches of laws and regulations. It's merely if you become aware of such breaches and laws and regulations. And just dwelling a little bit more on the final part of that definition, the organization's financial statements or its business in a material or fundamental way. We are only concerned with no-cla, and I can't emphasize this enough, that we are only concerned with breaches that could lead to a material misstatement to the accounts or substantial harm to the business. That could be reputational harm, of course, as well as financial harm. So breaches that are relatively minor, such as perhaps lack of disclosure of a certain item in a set of financial statements, which may not be particularly material. If it's not material, then we don't have to worry about it under no-cla, and it's unlikely to result in substantial harm. Minor breaches of hygiene regulations in the restaurant industry, again, they're unlikely to lead to a material misstatement or substantial harm. They would have to be quite major, perhaps, breaches of laws and regulations before it becomes an issue under the no-cla standard. And of course, the other item of substantial harm that could arise as a result of non-compliance with laws and regulations is that a business may be shut down, which of course leads to substantial harm. An example of that might be a serious breach of health and safety in a construction company somewhere around the world. In certain jurisdictions, health and safety is looked at very seriously, and if health and safety procedures are ignored by a construction company, then it is possible that the local health and safety regulatory body may come in and actually close down that construction company, or close down significant parts of that construction company, which may, of course, in turn lead to a scenario where the going concern concept no longer becomes appropriate. So if there's a breach of law and regulation which you become aware of, which could lead to a business being shut down, then that is certainly an issue under non-compliance with laws and regulations. What do you actually do if there is a breach which you find in terms of laws and regulations? Let's take the example of the health and safety laws and regulations which will apply in a certain country with regard to a construction site. And in the course of your consultancy work, perhaps, or during the course of the audit, let's say consultancy work for now, so that we can clearly distinguish between consultancy work and audit work. If you become aware there has been a significant breach of health and safety regulations by this particular client, maybe as a way of cost cutting in certain areas. So perhaps there are certain health and safety issues which they are not complying with, such as having a banksman perhaps assist construction vehicles during the course of a construction project. An entity may decide to do away with such banksmen where they are a requirement of the local health and safety regulations. If you become aware of such a breach, what do you actually do under no-cla? Well, the first thing you should do, particularly if you are lower down in the reporting chain, perhaps you are a senior or a manager in practice rather than at partner or director level, you need to report this particular breach of law and regulation further up the chain as a result of the no-cla ethical standards. Then the client contact partner would discuss the breach of law and regulations with the directors. If it is the partner or director that has found that particular breach of law and regulation, then they would actually discuss this particular issue with the directors. So let's say that you are a partner in a firm and you sit down with a construction company and talk to them about this particular breach. And their attitude is, well, thank you very much for drawing that to our attention. Perhaps it's not something that those responsible for governance, the directors of the construction company, were aware of, or perhaps they were unaware as to how serious this particular matter was. And as a result of the discussion that they have with you, they decide, well, actually, we are going to amend our procedures and reintroduce these banksmen, and therefore we are now going to be complying with the health and safety regulations moving forward. At that point, your responsibility under the no-CLAR standard appears to cease. There is no need for you to go back and check to make sure that what the director has said they're going to do, that they have done. You probably need to make an assessment during the course of meeting with the directors as to whether or not you are happy that they are likely to implement what they say they're going to do, but there is no requirement for you to go and check to make sure that the procedures have actually changed. If you are undecided as to whether or not the directors are actually taking the matter sufficiently seriously enough, it would be my suggestion that in order to comply with the spirit of the no-CLAR standard, that you probably do make a follow-up discussion with the directors in 1 or 2 or 3 months to make sure that what they said to you they were going to do, they have actually done. But I would suggest that there's no need, as this is not an audit assignment, for you to go in and actually make the actual checks yourselves. If, on the other hand, the directors actually turn around and say, well, we don't believe that we need to make these changes. We're quite happy with the money that we're saving by not employing these banksmen, or not as many banksmen as perhaps they should be. If they feel that that is the correct course of action for them as a business, and they're not going to comply with the health and safety regulations, then you need to think about appropriate action that you then need to take. What you then need to think about as the accountant under the no-CLAR standard is, depending upon the level of public interest and the response by the accountant, the response by the client rather, you as the accountant may have to take reporting action to the relevant authority. Just before I move on to that, just want to go back to the previous slide. In certain cases, there may well be anti-money laundering issues within certain jurisdictions, which will prevent you from discussing items of non-compliance with laws and regulations with the client. In that case, there are tipping off provisions under local anti-money laundering regulations and legislation. They will take precedence over the no-CLAR regulations and ethics standard. So if the directors do not take appropriate action as a result of your discussions, then depending upon the level of public interest, the accountant may have to take reporting action to the relevant authority. Now, one of the questions I frequently get asked when giving presentations on no-CLAR is who is the relevant authority in the case of non-compliance with laws and regulations? There is no central relevant authority. It will depend upon the nature of the law and regulation involved. Within here in the UK, if there was such a breach of health and safety regulations in the construction industry, the relevant authority would be the local health and safety executive. The relevant authority is whoever sets and regulates the rules that have actually not been complied with, that has led to an issue under no-CLAR. So there's no hard and fast rule as to who the relevant authority is. That is something which is down to the accountant's judgment. It should be relatively straightforward to find out who the relevant authority is, and if there is no relevant authority, then potentially no law and regulation has actually been breached. Another example which we haven't explored is perhaps the awkward example of a scenario whereby under no-CLAR, an employee in a firm of accountants becomes aware that perhaps the firm has a very laissez-faire, laid-back approach to the implementation of auditing standards and regulations within the firm and cuts corners, too many corners, on its audit work. In that particular case, the employee has an obligation as a professional accountant and NOCLAR to discuss the matter internally, perhaps with management. If they are not satisfied with the response that they get from management, they may have to take reporting action to the relevant authority if they believe that it is in the public interest to do so. The relevant authority there would be the audit regulator in that particular country for that particular type of audit work, as in fact in many countries around the world, there's a different regulator for public interest entity audits and non-public interest entity audits. That's a sort of snapshot, if you like, of going into the scenario of the accountant in business. The effect of NOCLAR, the accountant in business, is if they become aware that management are not complying with laws and regulations, they should discuss that non-compliance with management. And if they are dissatisfied with the response by management, then they have to decide if it is in the public interest to take reporting action, to a relevant authority, whoever that relevant authority actually is. So as we can see, the non-compliance with laws and regulations standard actually has the ability to be very, very far-reaching. And because it is a relatively recent standard that perhaps hasn't had much attention so far, it's not something that there are too many real-life examples on. It's a relatively recent standard, and I think further time and work is needed to consider the implications in the future, but it does have the ability to be particularly far-reaching. There is very little sign as yet of this having a significant effect on the work of accountants on a global basis, and that's in part due to the fact that on a global basis, different professional organizations, different professional accountancy organizations are implementing the non-compliance with laws and regulation standards at different times. Let's move on to look at a more specific example with respect to non-compliance with laws and regulations. Let's take the following example. You are undertaking the compilation assignment, preparing a set of accounts for a chain of bars and restaurants, and discover that the significant proportion of the staff do not have the appropriate work visas. What are your ethical responsibilities under non-compliance with laws and regulations? Now, the precise laws and regulations with regard to work visas will vary from country to country, and indeed, in my experience, it would be fair to say that some countries have a far more relaxed approach to people having the appropriate work visas than in some other countries. But if we assume that we are in a country whereby there are significant regulations surrounding work visas, what are your ethical responsibilities in this particular case? Well, if we take the situation before NOCLAR, depending upon the jurisdiction, the only issue would be possible money laundering implications. If it was a specific crime on an entity, a criminal offence, not to have appropriate work visas for all members of staff, if that was a crime, then potentially in many countries that would be a breach of money laundering legislation, and appropriate anti-money laundering reports would actually have to be made, and that would be the only issue when preparing the accounts. Obviously, when conducting the audit in this particular scenario, then you would have to have tested compliance with compliance with work visa regulations as part of the audit work. But we're not doing audit work in this instance. We are preparing the accounts. And whilst we haven't looked for issues surrounding staff not having work visas, it has come to our attention when talking to members of staff, perhaps, or one or two managers of the bars and restaurants have actually let something slip. So what are your ethical responsibilities now under the new non-compliance with laws and regulations standard? Well, if you are a senior or a manager that is preparing these accounts, you would make this report up the chain of command. You wouldn't immediately go knocking on the door of the board of directors or the group responsible for governance within the client and say, you're not complying with work visas, what are you going to do about it? Needless to say, I hope nobody would be so aggressive in dealing with clients. What you need to do is to make a factual report of what you have seen and the issues that arise under the no-CLAR ethical standards up the chain of command, initially to a manager and then up to partner or director level. It would then be down to the decision of the partner involved, partner or director involved on that particular assignment with responsibility for that client to decide whether it is a serious enough matter to discuss with the client's management. At this point, if it's a relatively straightforward case and perhaps the partner or director feels that this is a situation whereby a senior or a manager has simply been overly cautious in making this report, then perhaps they can write a file note to that effect, justifying under the no-CLAR ethical standard why they have arrived at this judgment that it is not something which needs to be discussed with the client's management, and it could be left at that. My suggestion is that at any point in time where a partner or a manager has to seriously consider whether or not the item is serious enough to discuss with the client's management, then they should actually discuss the matter within their peer group. That might be discuss the matter with an ethics partner within the practice, or with a technical partner within the practice, or if it's a relatively small practice, then maybe with some form of technical advisory service, such as from the professional accountancy body that they are members of, to actually assess whether or not the matter is potentially serious enough to discuss with the client's directors, management, those responsible for governance. If having taken advice, having consulted on this particular matter, the director has decided that it is serious enough to discuss with the client's management, then they should approach the client's management and say, we have found this particular breach. We feel there's a significant proportion of your staff that do not have appropriate work visas. What are the changes to your procedures that you will make as a result of actually us finding this out? If the client reports back and says, thank you very much for letting us know, we were not really aware of this being an issue, but now we will tighten up our procedures in this respect, then is it sufficient for the partner or director to leave it at that? Under the strict interpretation of the no-CLAR standard, then potentially yes. Under the spirit of the no-CLAR standard, I would, as a minimum, suggest the partner or director quiz the client further and talk to them about the precise changes to their procedures which they will make in order to make sure that the vast majority, or hopefully all of the staff, have appropriate work visas. If, however, the directors, having had the partner raise the issue with them, if the directors then actually say, well, actually, we feel that the work visa regulations within our particular country are very aggressive, very strict, and we feel that in order to actually maximize our profit, in order to keep our costs down, we are not going to obtain appropriate work visas for these staff, and we're just going to take a risk of not being found out, then the partner director and the accountants needs to consider a number of matters. First of all, they need to consider whether or not this could lead to a material misstatement to the accounts or could lead to significant substantial harm to the business. I would suggest that in the case of a potential fine for not having appropriate work visas, and also reputational risk, that in this particular instance, having a significant proportion of staff not having appropriate work visas, and that being a policy of the client's business, then that could lead to a material misstatement to the accounts, and could lead to substantial harm to that particular business. And therefore it passes that initial test of material misstatement or substantial harm. Then the next test the partner or the director needs to consider is whether or not it is in the public interest to actually make the report to the regulatory body. So the partner or the director then needs to consider whether or not it's in the public interest to make the appropriate report to the regulatory authority. In the case of work visas, that, in my opinion, would actually be quite a difficult report to make. I suspect if the reporting partner or director feels that there's significant public interest because of people being underpaid and being taken advantage of, and maybe some form of, for want of a better phrase, modern slavery, then that probably is in the public interest to make a report to the regulatory authority. If, however, the staff are being treated appropriately, then I think it's much more difficult for the partner or director to actually decide whether or not to make a report to the regulatory authority, which will vary from country to country, depending upon who is in charge of issuing work visas. So in terms of work visa non-compliance with laws and regulations, what's in the public interest is very much down to the judgment of the partner or director. In the majority of cases, my gut feeling, this is my personal opinion, is that it would be in the public interest. But in some cases, it might be justifiable to say, well, actually, it's not in the public interest, and therefore no report to the regulatory authority is needed. I'll come back to who the regulatory authority might be in this instance in a moment. I noticed that Jim Silf has asked the following question. The other implication might be the staff with no visas are being paid minimum wage. If the client was caught and had to employ staff with visas, the labour costs might go up, which might significantly, which might have a material impact on labour costs and therefore material impact on the financial statements. Yes, Jim, that's absolutely correct. The reason I didn't mention minimum wage is that it's not prevalent in all particular countries. Okay, in terms of who the regulatory authority is, then this will depend upon the nature of the issue. In the case of work visas within the United Kingdom, it would be the Home Office. I know, for example, that in Singapore, it would be the Ministry of Manpower. There'll be similar organizations and government departments on a global basis that will issue the work visas. And so the regulatory authority will vary depending upon the law and regulation involved. There is no hard and fast register of who the regulatory authorities are. As one or two people that have attended my presentations on NOCLAR in the past have wanted. They've wanted a sort of global list of who the regulatory authorities actually are. Okay. In the absence of other questions on NOCLAR, then my suggestion is that we move on to talk about the IESBA rules on partner rotation on public interest entity audit assignments. So this is an update on the current situation with regard to audit partner rotation according to the IESBA rules, although the way that these IESBA rules are implemented does vary from country to country, depending upon the views of the professional accountancy organizations, the PAOs, in particular jurisdictions. There's one particular item on here which we find that a lot of firms are not necessarily aware of, and is probably, I think, the biggest implication on here at all. So most people will be aware that on public interest entity assignments, the engagement partner needs to be rotated every 7 years, according to the IESBA regulations, and they must not be involved on that audit assignment again for another 5 years. They have a 5-year cooling off period. Hopefully you'll all be aware that on a public interest entity audit assignment now, which public interest entity audit assignments are largely listed entity audits, then not only is there an engagement partner, but there is also an individual responsible for the engagement quality control review, the EQCR, which is effectively an enhanced second partner review for those of you who aren't aware of what an EQCR is. The EQCR should happen on all public interest entity audits. However, the rotation rules under EQCR are different, and there's a maximum 7-year time on period, but the cooling off period need only be 3 years. And then you have this phrase, other key audit partners. And this involves audit partners of subsidiary entities in the case of a public interest entity group. And certainly we deal with a number of firms in the UK and indeed globally, whereby they undertake the work as subsidiary auditor of a group company, and the group company may well be listed on the stock exchange in the US or in Sweden or in some other location in the world. Now, under the IESBA Code of Ethics, that audit partner of the subsidiary is another key audit partner, and has to abide by a 7-year partner rotation period, but only have a 2-year cooling off period. So if you are involved in a practice that undertakes the audit of a subsidiary of a public interest entity audit, you need to be aware of this particular part of the IESBA code as well. Just moving back, there's another good question from Jim Silf, another good point rather than question perhaps, which adds that even if you decide if there's no reporting of no CLAR required, I would think that the accounting firm needs to reassess its client retention policy. The client says we know we are ignoring the law and we don't care. Management attitude should be an alert to whether this is a client we want to remain with. I couldn't agree more, Jim. That's an excellent point, which I probably should have covered in the presentation. So even if it is deemed not in the public interest to make the report with regard to the work visa issue, even if it's decided it's not in the public interest, when it comes to the time in which we have to decide whether to re-accept appointment as the preparer of the accounts on behalf of that client, then anything which actually adversely potentially impacts on your integrity means that you should probably not act for that client in the future. Because if they are if they lack integrity in the area of work visas, you want other areas do they lack integrity as well. I think that's a very, very important point. I think in terms of audit partner rotation, I think that's as much as I need to say. In terms of audit firm rotations for public interest entity audits, this is now gradually being introduced in different jurisdictions using different rules. I know that, for example, within the European Union, there are rules for audit firm rotations, but there are particular ways in which the EU legislation can be adopted, which is being adopted in different ways in different parts of the EU. So, for example, here in the UK, we have the rule whereby the audit firm has to be rotated every 10 years, unless the audit goes out to tender after 10 years, in which case the same audit firm, if they win the tender, can continue for another 10 years. And in fact, that piece of legislation is also being brought in on a piecemeal basis. So the first year, I think, from memory, in the EU, which is being affected by audit firm rotation, are audits being conducted in 2022 or 2023. So you need to be fully aware of your own country rules and the pan-network effect of different rules across the globe. The unfortunate, I think there are two, this is just my own personal comment, there are two unfortunate parts of audit firm rotation. Various studies that have taken place actually shows that audit failure has a much higher chance of occurring in the first year or two that an auditor has a particular audit, and therefore that must cast doubt as to whether or not audit firm rotation actually works. And it's also likely to lead to increased cost due to cross-network component issues. So, for example, in future, perhaps you may have a situation whereby a PwC audit is being conducted within a European Union holding company, and maybe the auditor rotation rules, firm rotation rules, are different in the US, where this company has a significant subsidiary, and PwC, although they can conduct the EU audit, may not be able to conduct the US audit, and therefore have to rotate. And another network, international network, or another firm would actually have to do the US audit, which would lead to additional work potentially within the EU holding company audit under ISO 600. So whilst I can appreciate where the regulators are coming from in terms of audit firm rotation, it is, in my experience, an area which a lot of the larger audit firms are actually pushing back on. And it is something that is certainly worth keeping an eye on in the future. In the current quite harsh climate of audit firm rotations may not be in place in 10 or 15 years' time, but we will have to wait and see. So I guess what I'm trying to say with regard to audit firm rotation is it is something which is very difficult to cover on a global presentation. It's something that firms need to be aware of and look at on a jurisdiction by jurisdiction basis and on a group audit basis within their individual networks. Moving on to the new IESBA ethics code, which has been released or is in the process of being released in draft form. For the most part, the rewriting of the ethical code involves rearranging parts of the code to make it more logical, to make it flow better, and to also increase clarity in the same way that the auditing standards were clarified in 2010. However, there are some minor changes which you need to be aware of in the area of the new ethical code. And particularly in part C of the ethical code, there is some tightening up of the procedures in terms of conflict of interests, and it's being emphasized that a conflict of interest may not just occur because a particular individual or a group of individuals or a practice may have conflict of interest between two particular clients, but they may have a conflict of interest between a particular client and some of their external and other interests. So where a firm has a conflict of interest between a particular client and an external interest in a particular matter, then that is something which they need to safeguard against. And if there's no appropriate safeguard, they may not be able to act for that client moving into the future. Also, in line, I think, with the views of many professional organisations around the world. Certainly, I know this is something that the Financial Reporting Council in the UK have tightened up on in their new ethical standard for auditors, albeit remember this new code of ethics isn't just with regard to audit work, it is for all professional accountants. Then the area of inducements, both external and internal inducements, is being tightened up. So firms are having to be very careful about internal inducements, and this is something which will come across more and more in future editions of ISQC1 as well, making sure that firms offer promotions and financial reward for good technical work as opposed to good commercial work. And in terms of external inducements as well, tightening up the guidance on corporate hospitality in particular, to make sure that not excessive corporate hospitality is given to a particular client or to a group of clients, and that also that firms and partners within firms in particular are not subject to potential inducements and having their objectivity compromised by accepting excessive corporate hospitality from clients, and also greater awareness of potential pressure from clients to act in a certain manner as well, and safeguards that need to be put in place. The new ethical guide will also talk in a little bit more detail about safeguards. So once the firm has identified a threat to its ethical behavior, then the threat must be addressed in one of three ways: to eliminate the circumstances creating the threat, in other words, to decline perhaps the corporate hospitality, to apply the safeguards, maybe such as second partner review on a particular assignment, or second partner consultation on contentious matters, or also probably the most drastic safeguard of all, to decline or end the specific professional service in certain circumstances. The ethical guide now will also talk about the need to step back when there are particular ethical issues that need to be considered, to step back to make sure there's adequate space and thought process given for what's the most appropriate conclusion. And if you cannot address the particular threat to your objectivity, to the particular ethical threat that you are facing, then you should end the engagement or decline the engagement, which I guess comes back to Jim Sill's point earlier on, that if management attitude is such that it may well impact on your integrity, which will remain, of course, a fundamental principle under the revised ethical guide, then you probably should end the engagement for that particular client that's so relaxed about its work visa situation. To close then, I just want to talk for the next few minutes or so on the monitoring group consultation, which I outlined at the beginning of the session. The monitoring group is an overarching group which feeds into the global standard setting process for the various IFAC standard setting boards, such as the International Audit Assurance Standards Board, the Ethics Standards Board, but also the Education Board and the Public Sector Accounting Standards Board. Back in November, the monitoring group issued a consultation paper on how to remove certain of the standard setting bodies, particularly the Audit and Assurance Standards Board and also the Ethics Standards Board, from IFAC altogether. Now, at the moment, because of the IFAC procedures, there is a certain amount of divorce from the management of IFAC and the operation of the Standards Board on a day-to-day basis. But according to the monitoring group, because of the way that the Audit Standards Board and the Ethics Standards Board are funded, they are not happy with the level of independence which they have from audit firms. So they issued this consultation in November on how to remove the standard setting bodies from IFAC and how they will be funded in the future. The most critical thing there, I think, is I've deliberately used the word how to remove the standard setting bodies from IFAC, not whether. So it's effectively saying that it's a fait accompli, it's a certainty, according to the monitoring group, that they believe that the standard setting process should be independent, much more independent from the profession. However, in my opinion, the monitoring group paper doesn't really give enough detail as to how that's actually going to be achieved. There are some other items within the monitoring group paper which international firms need to be aware of. It is clear from the phraseology and the terminology used in the monitoring group paper consultation document, and indeed they specifically say this, that the removal of the audit standards and the ethical standards from the IAASB and IASB is likely to lead to more prescriptive standards, more actual standards rather than the current principle-based standards. So standards are likely to be much more prescriptive in the future if this happens. Another concern of the profession is that the monitoring group itself, and therefore the future standard setting bodies, may well have a significant bias towards the audit of public interest entity audits. And also they talk about the fact that the IASB and International Audit and Assurance Standards Board possibly should be merged into one particular body. So, and again, that is very much leads into some concerns that the standards they will produce, both auditing standards and ethical standards, will very much be biased towards public interest entity audits. The responses to this paper need to be received by the monitoring group by the 9th of February, which is this coming Friday. So not much chance for any firms to actually submit, much more of a chance to submit views to the monitoring group. This is, I think, over the next 4 to 5 years, likely to change the way that standards and the nature of standards for auditors and indeed for all accountants significantly moving into the future. Okay, well, thank you. We're just coming up to 1 o'clock. Thank you very much for your attention this afternoon, this morning, this evening, wherever you are. I hope you found the last hour enlightening from an ethical standpoint. If you want to get in touch with me, those are my contact details in terms of my email address, Twitter, and LinkedIn profile. And if there are no further questions, then I hope you have a good rest of your working day. Thank you very much.